5 costly investment mistakes you can avoid. That's what we're talking about here today on 40 Finance. My name's Jeff Beers. Let's jump in. Okay, so investing mistake number 1, investing without a plan. And you see a lot of people do this where they haven't really identified what the end goal is. So if it's retirement, is it to make more money? Is it to save up for the future? Is it to get out of an income bracket and into another? Depending on what the goals are, your investment strategy would be different. So as an easy example, if you're very close to retirement, you obviously would not want to take on a high level of risk. But if your goal is to get rich quick or improve your income standing over the next 5 to 10 years, then you're obviously going to have to focus more on growth and managing your investments every day. So having a plan at the very beginning of your investment strategy is an important part of succeeding. All right, number 2 on the list, investing on emotions over information. So you get this a lot simply because of all the social media and television and everything else that you see out there, where people talk about stocks and somebody will hear about Netflix or Amazon or whatever the hot stock of the day is, and they'll immediately jump in because they're excited or they have a passion for the company, but they'll ignore some of the fundamental facts that go on, whether it's P ratio, debt equity ratio, earnings growth. They just won't even look into it. They just say, hey, I've got Netflix. I love Netflix. He's investing in Netflix. I'm excited about it. Let's jump in. And that's exactly where you can make a costly mistake, because depending on where that stock is it been on a 3-month run where it's very expensive right now and taking a step back and waiting for the right opportunity might be better? Or is it a highly leveraged company with lots of debt that could actually go under? Something like a Blockbuster Video comes to mind. So investing with your emotions over actual facts can be a huge mistake. Okay, mistake number 3, not understanding your investments. It comes to play in the stock market if you're buying stocks, kind of like I mentioned before, where you're not looking over the facts, so you don't understand exactly what the company does. But it also comes probably more into play when you have retirement plans and retirement accounts through employer-sponsored accounts that you're just putting money in, you don't even know what it's doing. You know, you'll sign up for a mutual fund that's Southeast Asia e-commerce giant or something, and you think it all sounds good, but you don't even really understand what's happening. And in these cases, that can be very dangerous, not only because you could lose money, but also because of the opportunity loss. So what if there's something that you do understand? What if someone can help walk you through the different options to tell you, hey, if you're not feeling great about this, here's a couple things over here that you might understand. And at least when people ask you, are you ready for retirement? Are you saving towards your goal? You'll have an answer that makes sense instead of just saying I shipped $50,000 over to my employee-sponsored program and it's doing well so far, you know, which is where a lot of people sit. So dig in, find out exactly what you have, understand what your choices are. Very important stuff. Mistake number 4 is following the herd. So the herd mentality is very prevalent across all investing circles, whether it's the daily trades on the stock market, whether it's retirement, savings accounts, recession rumors, whatever it is, there is always someone who's following the pack. And unfortunately these days, with the way news is a little spongy, I guess you could say, on the internet, you just have to be very careful with what you're following without asking more questions. So, you know, even simple questions like, is a 401k right for me? Is a 529 college savings plan right for me? Those are all things that come into play. and look into the details to see, does this match my family's goals? And that goes all the way back to point number one about having a plan. Don't just follow the shiny object. Figure out what you need to do in order to reach your goals. And a lot of times it'll be different. Everyone has a different situation. Everyone has different income, household expenses, number of people in their family. All those things impact the choices that you should make as an investor. Okay, so our fifth and final mistake is impatience. And you don't have to go very far to see this in the market. In fact, right now, with just the simple recession scares that I'll say that you see around the news, people are pulling their money out left and right, diving into consumer dividend stocks because they feel like the crash is right on the way. The problem with impatience is it usually costs you money. So you come in, if you're following the herd, you start to hear about a Netflix stock, just to pick on them a little bit more, and you plow all this money into Netflix stock or something related to it. Then you get to the point we're at now, where there's recession rumors going on and everybody's running for the hills and they're taking their money out and they're going into bonds and consumer staple dividend paying stocks. You haven't been in yours long enough in your Netflix to even make money yet. You're gonna sell the dip, so to speak, where you're giving up whatever gains that you made, or maybe you didn't even make gains yet, and you're plowing into the next company that people have already had a head start on. And losing that lead every time that you hear something going right or wrong, you're a step behind. Because if somebody reported it, the market has already reacted and you're a step behind. You're better off picking fundamentally sound investments and writing them out. And as you often hear the story of, buy the dip, that just means if you believe in a company, you should buy it when the price is lower. Don't freak out because Walmart stock went down 20%. If you believe in what Walmart's going to do over the next 10 years, then now's the time to buy more and basically get it on sale. So impatience will absolutely kill you over the long term because you'll be losing 20% chunks of your investment every single time, and you'll be flipping around all these places and paying fees and everything else. And when you wake up one day, you may have made gains, small gains across long periods of years, but the amount of money you've given up has cost you valuable compounding interest. So those are the 5 investing mistakes that you can avoid. Please subscribe to the channel, and I'll see you on the next video.